Good evening, everyone. Excited to have you all tonight here for our 2026 market forecast. My name is Ryan Bevilacqua. You'll see a couple other gentlemen here. My business partner, Corey Jacobson. He's also in here. We are Philadelphia-based real estate investors, and we've been investing for close to the last decade. We invest in small to mid-sized multifamily properties across New England, specifically New Hampshire and Vermont. And we are also the co-hosts and founders of the WealthJuice Podcast. Some of you may have listened to the show and found us here, but we've been doing our podcast for just about 10 years now. And the goal is to empower people to invest in income producing assets. And our goal is to also help shrink the wealth gap in America. So today, we're going to cover 2026 real estate market forecast, where we see rates likely headed and how this impacts you as buyers, and then also how to position yourself long-term for financing to benefit your entire portfolio. I think sometimes people think their loan doesn't impact their entire financial picture, and we're going to debunk that tonight. And leading the conversation, I'd like to introduce you to one of the masters of the industry, as we'd like to call him. His name's Josh Metal, and he is one of the founders of Neo Home Loans. He's built and managed a $100 million portfolio of over more than 170 doors. So he's been a leader in the industry for about 20 plus years now and is extremely passionate on this topic as well as macro economics. And so we're excited to dive in tonight. So Josh, without further ado, please take it away.
Thanks, buddy. Appreciate it, Ryan. Thanks for the kind intro. Corey, it's great to have you. It's great to partner with WealthJuice. And I want to make sure this is extraordinarily valuable for everybody that tuned in. So first of all, let's make sure we all know how to use the chat button. I'm going to put in there where I'm coming from tonight, which is Park City, Utah. So feel free to jump into the chat button. Let us know where you're from. And more importantly, let us know if you have any questions so that we can pause throughout this presentation. I'm going to break this down into 4 different segments of the presentation tonight. The first segment is going to be all about kind of the mixed messages that I'm seeing from the economy. At one moment, it looks like it's exploding. At the another moment, it looks like we're about to go in a recession. So I'm going to go over a few of those mixed messages that might be confusing people. Thanks, Kyle. Northern California, great to have you. Then we're going to go into a lightning round of review of 2025. Where did we end the year as it relates to real estate, and how is that going to impact your decisions? And then we'll go into 2026 forecasts. I'm going to give you a forecast on mortgage interest rates. We're going to go into real estate price forecast, and we're going to talk a little bit about inflation and the economy and how that actually fuels or impacts mortgage interest rates. One of the things that I think is important is that I don't just tell you the conclusion, but I show you the thought process. That way you can decide whether you agree and you think we're on the right track, or if you disagree. So we're going to get a little detailed in terms of some of the numbers. I challenge you not to tune out. I'm going to try to make it very simple to understand, but stick with it. Stick with us, because I think you're going to come out of this not only more educated on where the real estate market is headed, but the underpinnings and what actually drives mortgage interest rates and real estate prices. So I'm really excited to do that. And then we're going to end, thanks Ken, Weatherford, Texas, welcome. We're going to end with talking about what I'm doing in my personal portfolio, because not only am I talking about what I think is going to happen in the real estate mortgage market in 2026, but I'm actually taking action to prepare myself for those opportunities that I see in the market. So without any further ado, here we go. And Ryan and Corey, feel free to stop me, jump in, ask questions. If you see questions in the chat, please feel free to pause me and I'll answer those questions. So most of you, especially those of you that are Gen Xers like me, of course, remember the inverted dive scene from Top Gun. This is, of course, where Maverick and Goose in their F-14 Tomcat are flying upside down above the enemy MiG. And I don't know exactly what Tom Cruise is doing there, but he's giving some sort of signal to the Russian MiG driver there. And this picture seemed to be emblematic of how I'm looking at this year. Everything seems upside down, and there's plenty of mixed messages. Not only 1 week into 2026, and we get this news. Trump calls for Fannie and Freddie to buy $200 billion in mortgage bonds. This is a tracking of mortgage-backed securities, and you see instantly the price of mortgage-backed securities went up because a bunch of buyers came into the market to front-run this news, which means interest rates went down. We saw actually about a 0.25% reduction in interest rates. They backed off a little bit, but who would have called this when on their bingo card for 2026? And then I saw this from Grant Cardone. Many of you may know him as a kind of a real estate advice guru. He's also become very close friends with Trump and often seen at Mar-a-Lago. Look at these predictions. He says that he thinks that Trump may extend bonus depreciation to homeowners, meaning that an owner occupant could depreciate their home and write that off of their taxes. Wow, would that be incredible for housing? He's talking about potentially extending the 5% Fannie Mae loans so that you could buy 4 to 64 unit properties, 10x capital gains tax limitations on the primary residence deductible. So right now it's capped at $500,000. Above that, you pay taxes. They're talking about 10xing that so you could profit up to $5 million without paying taxes on an owner-occupied home. Incentivizing seniors with no mortgages to sell and offer owner financing. And then Trump to provide free Trump wealth education rallies. So, man, they're just buckle up. This could be a topsy-turvy, crazy year. And I read this morning that Goldman Sachs expects Trump's Davos speech here in a couple of weeks to talk about potentially changing the 401k and IRA tax treatment, where you could potentially pull money out of those vehicles to use as a down payment, as well as first-time home buyer subsidies. So the Trump administration is really trying to encourage home ownership and get home ownership levels back up, which could be great for us real estate investors. Now, let's get into some of the confusing things that I'm seeing. This is super interesting. Never before in U.S. history outside of recessions have we seen the bottoming of the unemployment rate and a rise in the unemployment rate being 1.2% increase in employment rate without going into recession. Never happened before. So this indicator says we're likely headed into an economic recession. And many of you may know something about the leading economic index. This basically tracks all the industries in the country, and it is a nearly perfect indicator of recession. You see, as the leading economic indicator in gold starts to turn over, we enter into these shaded bars, which are recessions. Over and over, as the economy and the leading economic indicators turn over, we head into recession. But for the last 4 years, leading economic indicators have gone down, and the stock market has continued to go up. Again, very confusing, upside down, just kind of a weird moment in time. And then this comes out. Last weekend, I'm reading my favorite economist, John Malden, and he's telling us that according to the early readings from the Atlanta Fed, they think that the gross domestic product, which is the overall production in the United States, is going to crush the original consensus of 3% and going to come in at 5.4%. I was listening to the All In podcast this morning. Those guys are some of the most connected, they know like all the billionaires, they're in the White House. Their estimates for the economic growth, GDP growth for this year is between 4.5% to 6%. So again, I just go back to this kind of very confusing setup where some indicators are saying there's going to be a recession. Others are saying the economy is taking off. It feels very confusing out there. And then of course, we've got the doom and gloomers. Don't buy a house this year unless you're a billionaire. Well, we're going to give you a lot of data today for you to make that decision. But here's what I know for sure. After 25 years as a real estate investor, one truth stands above all others, and that is more millionaires are made by time in the market than by timing the market. And that means when you're in the market, you have real estate appreciation happening, your loan balance is going down, and that's more indicative the longer you're in the market of financial success than trying to time the perfect bottom. I also know that homeowners' net worth are nearly 40 times greater than renters. And this is indicative of people being in the market rather than trying to time the market. All right, so what's going on as we end 2025 in the housing market? I'm going to run through a couple of quick slides. Then I'm going to pull down my slide deck. I'm going to bring Ryan and Corey in to comment. But here's how we ended the year. Mortgage payments have risen significantly. If we go back to 2000, the average mortgage payment was about $1,200 a month. Fast forward into 2024, mortgage payments were approaching $3,200 a month on average. This is median across the country, obviously. But we've seen those payments start to roll over as we've seen interest rates come down from their kind of cyclical peak at around 8%, now down to about 6%. We're starting to see a little bit more affordability in the housing market, but this has been a rough patch. This is really what slowed down the number of sales in the country. Of course, that's made the housing affordability come way down. These are kind of really ugly levels as it relates to housing affordability. And of course, that has impacted the share of first-time home buyers. Going back into 2010, 50% of the buyers that was happening with residential homes were first-time buyers. Today, that number's almost 20% because so many of those buyers have been priced out of the home. And if you listen to the University of Michigan, who does their sentiment report, 40% of people that are polled say this is a bad time to buy a home. But check this out. This is pretty interesting. Just back in 2024, 70% of people that were polled said it was a bad time. So we're starting to see some thawing. Interest rates move from 8 to 6. Housing gets a little bit more affordable. Those payments come down. Sentiment improves. These are leading indicators of what is likely ahead for 2026. And here's what I know for sure. This isn't a demographic problem. There are plenty of potential buyers out here. This is U.S. demographics aged 1 through age 99. And this shows the number of millions of people in those demographics. We've circled the age of 33 because historically, that's been the age of a first-time home buyer. Now, that's gone up over the last couple of decades because housing's gotten a little bit more expensive. But the point is, our birth rate is very, very strong. This drop in the birth rates here, this is Gen X. This is the generation that trailed the boomers, and there was a demographic drop in birth rates that happened. We're not experiencing that now. We've got very strong demand for housing. We just need to get the affordability thing figured out with a little bit lower interest rates. And again, we've seen this trend towards older and older buyers. But here's the good news for those of you that are real estate investors. If people are older before they buy, then that means they're what? Well, they're likely renting for longer. So there is some upside for those of you that are real estate investors. Now, I don't think this is anything like 2008, and here's why. Look at the number of free and clear homes in the United States. Nearly 40%, 4 out of 10 homes on your city block are free and cleared. How about household equity? All-time high, almost $35 trillion in equity in U.S. housing, which means the average homeowner has $400,000 in equity. Absolutely staggering. And what about mortgage delinquency rates? Mortgage delinquency rates are still at near 4%, which is some of the lowest historically ever. We saw in the Great Recession up to 10% delinquency rates. We're just not seeing that now. And I think that's largely because of the low interest rates that are in effect and obviously the amount of massive amount of equity. Guys, before I jump into 2026, let me take a pause. What do you have to add? What questions do you have?
I'm just going to mention a couple of things to talk like a little bit of a note of our personal portfolio and what we've seen over like this stalemate as interest rates have risen and people have held longer, right? So from a personal standpoint, we've had properties that we purchased in 22, 2023 that we were attempting to refi with rates going up. We weren't able to. So what is that doing now? Now, as we've purchased, even at 6 and 7% interest rates, as you're seeing them dip into the fives, we're thinking about refinancing. We don't have like a massive portfolio or anything, but if we're talking about 3 or 4 buildings that we've purchased in the past couple of years that we're now looking to refi, it's going to open up to the rest of the market. And a lot of people are going to, whether they're refining, but also selling. We've sold off a couple of our properties that have appreciated significantly in the past 5 or 6 years.
And when we purchased them, the interest rate was 4.75. And the new person who purchased it, as just like an example of a single family home, was at 5.9 or 6.1. So people are still, they're able to, especially in the last like few days and weeks, get back into the market. So I think the stalemate is going to be broken a little bit. Obviously, we don't have a crystal ball, but that is kind of my take on this. And that, but still, it remains that everyone has this equity in these properties. So I don't think it's going to be a flood of people selling. I just think more so than the past 6, 12, 18 months.
Yeah, I couldn't agree more. And one thing I want you to touch on, Josh, if you can, is you mentioned a staggering number of people that have a massive amount of equity stocked up in their primary residences. And this is how Corey and I expanded our portfolio tenfold. And so we tapped into our primary residences. We pulled home equity lines of credit. And that's an amazing tool and product. Now, we were always told that you couldn't get, as an investor, you couldn't pull a line of credit off an investment property. We've come to the conclusion that you actually can do this, and you guys actually offer those products. So it's a unique lane to Neo and to yourself. And I really want you to talk about that as you get into the presentation, because there's actually, I see a lot of our crew in this webinar that are looking to scale their portfolios. They have 1 to 2. And this is a very unique identifier that is it's going to absolutely allow them to scale. So please touch on that a little bit as we go further.
Yeah, you think about $35 trillion in equity, average homeowner, $400,000 in equity. And of course, that includes the people that have free and clear homes as well, right? But it's a staggering amount of equity. And there are home equity line of credit products, and I'll define that in just a moment, that are available on primary residences, secondary vacation homes, and investment properties, even if you own a duplex, triplex, or fourplex that's an investment property. Now, the nice thing about a home equity line of credit is, in order to get access to that equity that's frozen behind the sheetrock of your homes, you don't have to refinance that low first rate mortgage rate. So if you're sitting behind a 2.75 or 3.75 and you just can't bring yourself to bear refinancing out of that low rate to pull equity, you can leave that alone. This is a second mortgage that goes over the top of it that enables you to extract equity. The other thing that's nice about a home equity line is it acts similarly to how your repayment agreement works on a credit card, meaning that if you have a credit card with a $10,000 limit, but your balance is zero, it doesn't cost you anything. You only pay interest when you use the credit. So you can use that to go buy an investment property. Then you can take the cash flow from the investment property and you can quickly pay down the home equity line of credit. It's not a fixed payment. It's adjustable based on that balance. So it's an incredibly powerful tool for real estate investors for certain. Great. I'll jump into...
Any other questions? I just want to see if anybody else has any questions just before we hop back onto the screen here. And if you get them along the way, just toss them in the chat, and Josh, I'll chime in with them.
Great. Fantastic. All right. Let's move into 2026, and we're going to talk a little bit about what mortgage interest rates are based upon, because a lot of people think that the Federal Reserve sets mortgage interest rates, because we're always talking about when the Fed is going to lower rates. But here's the reality. The Federal Reserve does not dictate mortgage interest rates. Quite literally, actually, let me just bring down my screen for a second. Quite literally, the Federal Reserve sets the Fed funds rate, which is a 24-hour overnight lending rate that banks charge to other banks to borrow excess liquidity and reserves. So if one bank has a client that leaves them and takes $5 million out the door and they need additional liquidity, they can borrow it from Bank B overnight at the Fed funds rate. So it just makes sense that a 24-hour lending rate would have nothing to do with a 30-year mortgage. Now, oftentimes, the Fed funds rate, short-term interest rates, and long-term interest rates like mortgages may be going up or down coincidentally at the same time because of different driving economic factors. But you should know that the Fed does not set mortgage rates. Okay, well, if the Fed doesn't set long-term rates like mortgage rates, what does? Well, the answer is the market. And the market prices long-term rates based on inflation. So this is a graph of the 30-year fixed mortgage rate going back to 1970. And the green line is the consumer price index. That's inflation, a measure of inflation. And the gray bars that you'll see in a lot of my slides, that means there's an economic recession during that period of time. So you'll see inflation picks up and mortgage rates follow. Inflation rate picks up and mortgage rates follow. Now, think about this from an investor standpoint, and here's why this makes sense. If I'm going to buy a mortgage bond as an investment, or let's just say I'm going to make Ryan a private money mortgage out of my own retirement or savings funds, and Ryan's going to pay me 6% for the next 30 years. Well, that's great unless inflation is eroding the buying power of that return. So I may think 6% is a fine return when inflation is at 2%, because that means my real rate of return after inflation is 4%. But if inflation goes to 6% and Ryan's paying me 6%, that means I'm actually making zero. So when inflation starts to pick up, investors say, I don't need a 6% rate, Ryan. I need an 8% rate. So inflation, if you want to know where mortgage rates are headed, then you watch inflation. It's not what the Federal Reserve announces for the Fed funds rate. So what's going on with inflation? Okay, there's two different primary measures of inflation. I'm not going to get too far into the weeds, but you should know CPI inflation is what is normally in the headlines that people track. But PCE inflation, just another reading, they just weight things a little bit differently. That's what the Federal Reserve looks at. So we have both in here. And those are running right now between 2.6 and 2.8, depending on which flavor of inflation you want to look at. And it looks sticky, like it's not going down. But the reality is much of that is old data. And again, I'm going to keep this high level, but shelter cost is distorting the inflation numbers. The inflation numbers should actually be lower than they are today, because the way that inflation is measured is in the rear view mirror. Because when you sign a lease to rent a home, that lease is usually 12, 18, 24 months long. So when they're measuring in the rate of inflation or the increase in rents, they're actually looking at rent agreements that were signed a year or two ago. So for example, in CPI, 40% of this inflation reading comes from shelter. In PCE, 17% of this inflation number comes from the housing component. And what the inflation numbers are currently showing is that we're seeing 3.7% inflation in housing costs. But we know that's actually not true. So this is the inflation component. This is the housing component in the inflation numbers. It's coming down, but in the current numbers, it still shows 3.7% housing inflation. The reality is actual new rents are actually down year over year, 1.3%, and rent renewals are up 3%. So on average, we're seeing about 1.9% increase in real time in rents. But the way the government looks at it, it's 3.7%. I know that's nuanced, but it's important for you all to understand why we are forecasting lower inflation. So current core PCE inflation, which is what the Federal Reserve looks at, 2.8%. We believe it's overstated and going to come down for a couple reasons. It has some noise in the inflation rate right now due to tariffs that are going to work its way out. There's the shelter lag that we just talked about that we believed is inflating that number by about 0.3%. And there's this weird thing called the portfolio management fee inflation, which is because stock prices are at an all-time high and portfolio management fees are at an all-time high. And we think the stock market may either flatten out or come down a little bit. It can't hit all-time highs forever without taking a breather. So all in all, we think that there is an overstatement in the inflation rate by about 1.9%. We think that'll work out, and we'll see the inflation come down from 2.8 to 2.5% in the next year. That's important because that's the primary driver of mortgage interest rates, and that's why I go into that level of detail for you. So let's talk a little bit about the labor market, because there's a slowdown happening. And when the labor market slows down, that's a sign of lower inflation. So we see continuing jobless claims. These are people who have lost their job and they're having a hard time finding a new job. Well, we see that those numbers are going up. More and more people doing continuing claims, not able to find employment. We see that the job openings report, which is the number of open jobs posted across America, was as high as 12 million job openings in 2022. That's down to 7 million. That's down 5 million less job openings in the country. And we see two different employment payroll reports. One of them is from ADP. ADP processes roughly 40 million workers' payrolls nationwide. Over 1.1 million companies use ADP, so they have vast data. And this just shows the number of new jobs added per month. So you can see back in 24, we were about 200,000 new jobs added to the economy per month. Well, look at it now. We're hovering right around zero. We had a negative print, then there was 100,000 the next month, then zero, then negative, then 50,000, then negative. So we're now moved from about 200,000 jobs being added per month to almost zero. So that's a major sign the labor market's slowing down. The other major labor report is called the BLS, the Bureau of Labor Statistics. And they show in 2024 that they were saying there was about 300,000 jobs being added this month, down to 100,000. But still, we see the trajectory is down. They're still forecasting about 50,000 jobs. But again, they've had some negative prints. So everything is showing me that we're seeing a slowing in the labor market, which is deflationary, which is going to be kind to mortgage interest rates. And as I mentioned before, we've seen the unemployment rate bottom and now rise. And every time that's happened in the last 100 years, you've seen a decrease in inflation. So all that to say, we see mortgage rates coming down. And our friend Scott Besant over at the Treasury, he is shooting for a Treasury rate on the 10-year Treasury of 3.9%. Now, this is super, super important because the 10-year Treasury and 30-year fixed mortgage rates have a very consistent relationship because most people only keep their 30-year mortgages for about how long? About 10 years. So there's been a relationship between the 10-year Treasury bond yield and mortgages. Scott Besant wants to get this down to 3.9%. He's been quoted saying the 10-year yield is going to naturally come down as we see energy dominance. Anybody see gas prices coming down recently? Deregulation. We're definitely seeing that through a lot of industries. And non-inflationary growth. Well, the inflation rates have been coming down, and we're about to print a 5% GDP growth for the fourth quarter of 2025. So far, this guy's been pretty dang on the money in terms of what he's been forecasting. And if Scott's right, we hit down to about 3.9%. We actually think it could go a little bit lower than that. We actually think it could hit 3.8%. This is a technical chart of trading of the 10-year Treasury. And we've seen in over 2024, it's hit this 3.8 level several times. We think we'll end up closer to 3.8. Right now, we're at 4.2%. So that means we're going to improve by about 0.4% on the 10-year Treasury. And there's one other component to pricing in a mortgage rate you should be knowledgeable about, and that's the spread. It's the spread between the 10-year Treasury rate and the 30-year fixed rate. Now, historically, that spread has been between 1.6 and 2%. It vacillates. Right after COVID, you saw that spread blow out. And then this is when the COVID lows for mortgage interest rates were super, super low. The spread got down to about 1.2, 1.3. Well, today, the current spread is 2.12. Just last year, that spread was 2.6. So we think this spread is going to narrow. So if we take these two things in combination, we end up seeing a 10-year Treasury that we think will come down to 3.8. We think that the spread between the 10-year Treasury and the 30-year fixed mortgage will continue to contract to 1.9. So we think we'll see a 30-year fixed mortgage rate hit as low as 5.7%. Now, will it stay at 5.7% for the whole year? I don't think so. I think it is going to vacillate. We'll have crazy topsy-turvy upside news that may drive rates up or down. But I think we have a really good shot of seeing 5.7% in 2026. And that's going to pull a lot of buyers into the market. It's also going to make a lot of Americans happy again before the midterm elections. So the numbers show that if we get, this is the number of millions of Americans that are eligible to refinance their mortgages based on interest rates. So if we get down to 5.7%, all these millions of people, that's 34.3 million people, will be able to refinance their mortgages going into the 2028 midterms. And wouldn't that put them in a little bit better mood? Guys, before I go into the real estate forecast, what questions did you have about what I just got over, or what did you think was interesting?
I can jump in with one. My thought process is, I'm a real estate agent, right? And you're seeing this this is what real estate agents do and say, right? But I'm curious about your thought process when you may hear like, hey, now is a good time to buy, buy now, date the rate, and refinance later. Just knowing what you know and what you've developed in your own portfolio as a real estate investor, do you generally like that thesis? Because, and I'll tee you up a little bit because I asked the question because you brought an example to us in our community about how you purchased a property, in 2002 and have since refied and pulled lines of credit and done a number of things with it, and you still own it today in 2026. So is that strategy something that you're thinking about if interest rates are going to dip and then maybe bounce back? If your goal is to hold for the long term, do you feel like that's a good strategy? I'm curious.
So what we know 100% for sure is that mortgage interest rates are cyclical. They go up and they go down. So when mortgage interest rates are high, where's demand for housing? It's low, right? Because when mortgage interest rates are high, housing payments are higher. If I'm a real estate investor, it's harder to do cash flow. You have low demand when you have high mortgage interest rates. Conversely, when interest rates are low, where's demand? Demand's high because I can get cash flow as a real estate investor. And if I'm a renter, we saw the age of the first-time home buyers move from 30 to 40 over the last 20 years. Well, where are all of those people aged 30 to 40 living then? They're either in their mom and dad's house or they're in an apartment. Well, as those mortgage rates come down and housing becomes more affordable, and all of a sudden they go, wait, now's the time. I can jump from my $2,700 rent payment to a $3,300 house payment, but by the time I factor in the tax deduction, I'm really paying the same thing. Now's the chance. I'm going to move over there. So if we know that mortgage interest rates are cyclical and demand is low when rates are high, if you can afford it, wouldn't that be the time that you want to buy your house? Because there's more houses on the market, there's less competition, you can get more concessions from the seller. You're not negotiating against 5 other people and bidding up the price. So in many ways, that's actually the best time to be a buyer. And the cool thing, that I know there's been some pushback about buy the house, date the rate, because mortgage rates have stayed higher than people expected for a longer period of time, right? We thought they were going to go like this, and they kind of went like this, right? Now we're starting to see them go down. So I think you're going to see a lot of people who've bought over the last couple of years in 7 and 8% rates. I mean, we literally have hundreds of clients that we've developed what we call strike rates for, which is the rate that it makes irrefutable sense to restructure that mortgage. So if you're at 7, at 6.25 or 6.1, it's going to make irrefutable financial sense to do that. And then we're tracking those loans to refinance them. I think that strategy has just gotten a bad rap in the last year or two because rates stayed higher for a little bit longer. But as rates come down and demand increases, you're going to have that competitive housing market again, and you're going to have multiple offer situations, et cetera.
One of the things that I wanted to caveat here is just, we are talking majorly macro in this presentation, but
yes,
when you when we talk about real estate markets, what we really need to do is go micro. And I mean not just micro like the city of Philadelphia where we are, but like the
The
city
streets.
versus the suburb. Yeah, like yeah, exactly, the streets. Because I was showing investors some properties today, literally, and there's properties that in the metro area of Philadelphia, just as an example, I know you're in Utah, but that are sitting on the market that are prime. Buyers are winning in the city. This is what's happening. Ryan, as an example of purchasing his primary residence 35 minutes north, where he had to make an offer the same day because there were 13 people that saw it still. And we're talking about a 30-mile, not even probably 20-mile difference. And it's not every suburb is the same, too. So I think that as we get into talking about the real estate market, I want people to think about the fact that it's very street level, right? But there are some trends that will dictate kind of the overlay of what will happen.
Just to
Correct.
piggyback off that real quick, Josh, also, can you talk about the neighborhood report card? I think it plays perfectly into this for the people that stick around to the webinar all the way to the end, what they'll get, and it kind of like we can talk street by street.
Yeah, great call out. And it's one of the gifts I'm going to give everybody who sticks around till we wrap up here. But the neighborhood report card is professional grade analytics. There's a reason why hedge funds have advantage in things because they have better data than we have. This is professional grade analytics looking at the micro markets. So not macro across the United States, but literally down to the zip code. And what's also so important that this report does that others don't is you can tune it by price. What most people don't realize is if your $400,000 home is going to appreciate or perform very differently than a $2 million home. But when we look at neighborhoods, usually they just say, well, what's happening with the median price? Well, that doesn't give you clarity on how your home is going to perform in that specific area at that price. And then it gives you a bunch of other local community employment data, income, number of new homes being built versus buyer demand. It's very detailed.
Perfect. Thank you.
Yeah. Yeah. Just anecdotally, as Ryan was buying his new house and we were having a conversation, we pulled up a neighborhood report card, fine-tuned it for the area and the price, and went over the data. And it's pretty impressive.
Yeah, it's very impressive. Actually, it helped me solidify. I knew I had no choice where I was moving. My wife grew up in this town.
Ask his wife. Yeah.
Yeah,
He
that
had no
was kind of
choice.
out of my hands. But to know that I had the report card I got 90%, I think it was 90. It was an A at least. So I felt good about it. So it's good stuff.
It's clear she's the CEO and you're the CFO.
Yeah, you nailed it. You nailed it. But I will say this, what I thoroughly enjoyed about our conversation, just to give like a peek behind the curtain, all the AI software that you guys use to give so many different scenarios on, talking rate, but you remind me, we've talked about this a little bit at length here. It's most of us on this call, right? We're trying to get our financial house in order, and we always think that we need someone to help us with all of our assets, right? And like the things that we've accumulated over time, and that's typically like a financial advisor. And I think a lot of people forget about the other side of the coin and the liabilities that they have and the loans that they have. And so I like to view you guys as a liability advisor, right? Someone that comes in, takes a look at the entire financial picture, and says, "Hey, listen, consider this product or this loan 2, 3, 4, 5 steps down the line." And in our conversation, we talked at length. We have a large multifamily portfolio. Corey and I, I was keeping my primary. I was converting it into a rental, then buying a new primary. And so there was a lot of moving pieces. Yes. And we were also shelling off a couple of our projects. Corey and I had 50-50. So there was a lot to the landscape. And I'd imagine a lot of people on this call and people that we talk to as investors have different outlooks of their portfolio in the long term. And I think it's important to talk about this stuff on a macro level and a micro level. And it's personalized. Too many times you book a call with a mortgage lender and it's just like, hey, here's the rate we can get you. This is what you guys can afford, and go buy it. And here's what you should take down. And I was just pleasantly surprised. And this is by no means a sales pitch to you guys. I'm just saying the neighborhood report card solidified it. And then maybe if you could talk about a little bit, some of like the analytical tools you guys use and the AI and just how it's kind of changing the game as we kind of navigate the future.
Yeah. Yeah. To the point you brought up first, many people have a financial advisor, but nobody's really playing the role of a liability advisor. And that's so important when you're thinking about multi-step moves, when you want to play chess versus checkers. And one of the things we help people think through is, how do you use leverage either on the home you're in now, the home you're buying, other properties you have, to improve your global cash flow? Because that's the name of the game, right? The name of the game is, if I can increase my cash flow, then I can put more money towards my retirement investments, and I can grow that nest egg as big as humanly possible. And there's a lot of focus in the industry on the asset side, which leaves the liability side largely neglected. And so we use a lot of AI tools to track those things and to do those types of analysis, things called total cost analysis, that enable us to show different types of loans on different properties over different periods of time, and not only what the total cost is, but what the total savings is with one strategy compared to the other. Things like the strike rate tracker. So we have tracking of every single mortgage of our clients, and as interest rates tick down, we're calling you up and we're saying, hey, Ryan, it's time. We've hit the strike rate. You didn't have to watch that. So those tools enable us to be an effective liability advisor at scale.
Yeah, super effective. And it just made me feel really good coming out of that call. So yeah, I appreciate it.
Really appreciate the kind words. Thanks for bringing that up.
Mm-hmm.
Okay, let's move into the real estate section. So let's talk a little bit about supply and demand, because I don't think you can have a thesis on the direction of home prices without understanding that. So this is household formations that are being measured. And what are household formations? Well, right now, myself, my wife, and my 2 kids, we live in one household. But eventually my son will move out. That'll be 2 households. My daughter will move out. She'll create a 3rd household. And then likely my wife will divorce me shortly thereafter, and that'll be 4 households. No, I hope that doesn't happen. But whenever you have a divorce, or whenever you have somebody move out of their parents' home, that's a household formation. And when somebody moves out of their parents' home, they only have a couple of options, right? They rent, they buy, or they move under the bridge. So let's assume most of those people, hopefully, are going to rent or buy, and that can give us an indication of demand for a housing unit. Because if you move out of my house, you're going to need your own housing unit. So that's really, really important. And if you look at household formation, this is really interesting. This is kind of vacillated between about 2.2 million and about 1.2 million. This has kind of been that range of household formation. Let's just call it an average of 1.8 million. But what has happened over the last couple of years? Let's call it since summer of 2023, the number of household formations have gone down. Now, I showed you a demographic chart earlier, which showed that the number of 40-year-olds to 20-year-olds wasn't shrinking. So if the demographics aren't shrinking, how are household formations shrinking? All those people are living in their brother, sister, mother, cousin's home. They're not forming new households, which means there is a tremendous amount of pent-up demand sitting on the sideline, waiting to move out and form a household when they can afford to do so. Now, on the other side, and this is the pent-up demand, obviously. On the other side of that is supply. So how do we add supply to the housing market? Well, home builders build homes, and we can track that very consistently, because you have to get a permit to build a home, and that's called a housing start. So if we go back over the last 5 years, you can see that the number of housing starts, permits to build a residential unit, crashed in COVID, right? We thought the world was ending, but is more or less vacillated between 1.4 million and 1.8 million, and is now down to 1.2 million housing starts. Why is this important? Because home builders, as interest rates went up, started building less homes. So there's less supply coming to market. Meanwhile, there is a ton of pent-up demand. All these household formations are sitting on the sideline. So if we have a slowing job market, lower inflation, lower interest rates, improving affordability, that brings this pent-up demand off the sidelines into a market where home builders have scaled down. that's a perfect recipe for appreciation. And that's exactly what we think is going to happen in 2026. So in summary, we think the unemployment rate's going to rise to 4.8. We think inflation's going to fall to 2.5. We think we're going to see interest rates hit as low as 5.7, and we're going to see 3.5% home appreciation, which is very, very considerable. Last year, we don't have the final Case-Shiller, which is kind of the gold standards for appreciation, but we'll probably end the year somewhere around a 1% appreciation nationally, which again, that's macro, not micro. Your market might be less or more, but we think we're going to see considerably more appreciation for last year because of the pent-up demand and because of the improving mortgage interest rates. Now, guys, before I turn it back over to you, let me just quickly walk through what I'm doing with my own portfolio because I believe this is where we're headed, lower rates, which is going to bring more demand. I have 4 apartment buildings right now that I've listed for sale. This is Capitol Hill Villa. I bought this building in 2001. This is the one we did a case study on your guys' podcast. This is Clinton Village. I bought it in 2004, an 18-unit apartment building, I think. This is Vine Street, 7-unit apartment building. This actually closes tomorrow. Bought it in 2012. And this is Parkway Apartments. This closes the 30th of this month, owned since 2015. So why would I be selling 4 apartment buildings that I've had for over 20 years right now? It's because I believe we're going to see lower mortgage rates. Lower mortgage rates brings more demand. More demand push prices up. So if my job as an investor is to move from small properties to big properties, do I want to buy the big properties when they're more expensive, or do I want to buy the big properties when they're less expensive? Like, this is the moment in time right now. Rates are coming down. We haven't seen demand and prices spike. Like, this is the perfect nexus moment of opportunity. And as a result, we're selling $20 million in properties, and we're going to turn around and buy $50 million in properties. And I want to do that before those properties come up. And the last thing I want to just show everybody, and I'll turn it back over to you guys. Like, I don't know if you've been following, love him, hate him, don't care. This is economics. It's not politics. But the White House is fixated on making housing affordable and getting rates down to 5.7. Now, Donald tends to exaggerate a little bit. He's off by about 0.3% here. Mortgage rates are closer to 6% than 5.7. But you can tell this is what he is going to try to win not that he's up for re-elections, but the 2028 midterms is going to be about affordability and bringing prices down for Americans. And I think he has a pretty good chance with all the tools at his disposal. Guys, what do you have before we jump into the gifts?
So I just want to call out, there's a question in the chat. So I'm going to read it to you. Trevor asked, many have a home that of course has appreciated over the past 10 years and locking into a 2.5% interest rate years ago. Are you seeing people cash out and sell those properties and invest the equity, or put it into another property, or just rent the thing and work towards buying another property? What are you seeing trend-wise?
Great question. I'd love to hear from you guys too. The answer for me is I'm seeing both. Like Ryan's a perfect example of this, since we've already brought up his situation, and I'll let you tell that story, Ryan. But we're seeing people like Ryan who have decided, wait a minute, when I analyze the cash flow on this thing and I forecast that out over 20 years, I'm going to be way more wealthy turning this into a rental property with cash flow, appreciation, paying down my mortgage than I would by selling it and taking the assets elsewhere. But I also see some people that just don't have the desire to be a landlord. And maybe that's because they're overwhelmed or they're fearful. And really that's where you guys come in. These guys are the preeminent coaches of helping people feel less overwhelmed with the process of buying their first couple of investment properties. So you guys should probably talk about that as well when you answer this question.
Sure. I'll go briefly into this, and I know Cora probably wants to jump into, but Trevor, I hate to say it because it's annoying when people say this, but it depends. And for me, I had a 3.375% interest rate on a property that I bought in 2018 for, let's just call it 360,000. It appreciated. It's worth about 560 to 600 right now, but the rents have continued to climb. So my mortgage is just about 1,900 bucks, and we were able to garner $3,600 worth of rental income. And so the spread there was huge. And for me, I'm viewing this as, Corey and I are real estate investors. We've our hands in a bunch of different income producing assets or things that like we can store our value in, a mix between real estate, stocks, crypto, all the above, right? But for me, the 401k is taken care of, right? And that gets dipped into every single month or accumulates over time. For me, you know, sometimes it takes 3 to 5 properties to get that amount of cash flow. If I can build a small but mighty portfolio and have one property that I can hold, that's my golden goose. And I mentioned to you before earlier in the webinar, we pulled home equity lines of credit out. When I was living in that property, I pulled out a $100,000 line of credit when I probably had like $250,000 of equity in the property at the time. That allowed Corey and I to go put a down payment on 2 other properties. He did the same. So, and by the way, we got to split the risk there, right? Because we each went 50-50 on those. So we scaled to like about 4 at that point. So my point is, that allowed me to do way more than what I could do by having that just by like leaving it into like a 401k or like the stock market. And I just like using this as like a machine to continue to keep growing. So for me, I think it depends on your property, but if you have a rate that low, I don't think, and Josh can probably double click on this, I don't think rates will ever go that low again in our lifetime. That was a catastrophic event. The world shut down, and like, it was just something it's never happened before, right? Could happen again, probably not. So I would say if you have something that you've been able to take advantage of without even knowing it, I would probably hold that, find a way to see if you can rent that or pull lines off of it and invest in the next thing. But we would have to do a really deep dive deal analysis on that to see if it makes sense. That's what I did. And so, the long and short was we decided to keep the property, pulled the down payment from a couple other avenues and just put down the 20% on the new home. And now I have an income producing asset where it's just another, basically another salary that I get to pay myself. And over time that rent will increase. I think it's going to go to, I don't know how long it's going to take, but up to probably about 5,000. It's going to cover it's going to cover the current mortgage. And then it currently covers a good chunk of my current mortgage too. So it was a win-win to hold it. And I think you're going to see a lot of people do that. I feel like there's a lot of, I don't know what you want to call them, maybe not golden handcuffs, but there's some sort of handcuff to that rate. What I'm seeing.
A lot of accidental landlords will come of it. And then that could win too. Not accidentally start winning because of it, but go ahead, Josh.
Just one quick thing I remember from your situation, Ryan. I also encouraged you to look at your amortization chart on how much you were paying towards principal. And one thing that most people don't understand, if I have a $400,000 mortgage at 7%, I'm only paying maybe $300 a month towards principal. If I have a $400,000 mortgage at 3%, I'm paying $900 a month towards principal. So the lower your interest rate, the more that's going to principal, regardless of where you are in your amortization schedule. And that's another thing when people think about walking away from the home, they usually think about the cash flow. Sometimes they think about the future appreciation they'd be walking away with, but rarely do they think about the power of the amortization when you have those low interest rate mortgages. So just one other thing to add to that equation.
Yeah, and there's so many different scenarios you can run for yourself just on a quick whim. Like obviously it's nice to have someone to look over your shoulder, which I had Josh to really analyze this. But my initial steps were to pull the amortization schedule and toss everything into ChatGPT and say, hey, what's the based on where I'm at now, what's the optimal rate where I should start? Should I continue to pay down this loan? Should I refi or not refi? Should I sell this property? And I basically pulled a bunch of different scenarios out before I made a final decision. But it was really interesting to see how much I was paying down on principal every month. And I think I got an analysis of the optimal amount of dollars I could put in was another $20,000 to pay down to the principal. And then I'd be at the most optimal amount without like extinguishing a lot of cash where I can invest that in the market and have it go up. But it was really cool to be able to dial that far deep where I think, back in the day, we'd probably get just like a simple answer, like, yes, you should keep this, or no, you shouldn't. But like why I should do this was important to me. And the exact dollar amount amount and when I should put that in, because then you can go into something that, I'm not the most deeply educated on this. So I'll let Josh take this, but like mortgage recasting. So at one point you can recast the mortgage to have payments stretch out over time. And we don't really probably have to get into this on this call because it's a little layered, but that's something I'm going to look to do, as the principal goes down even further.
All right. Corey, anything you want to add?
No, I think that was it. I know you want to talk about your gifts, and then
Sure.
Ryan and I will mention
Wrap it up.
what we do as well.
Great. Okay, so I dropped this into the chat, and you're also more than welcome just to use the QR code. But I have 3 gifts for you. If you're thinking about buying, selling, or investing in real estate, I think this is going to be very beneficial for you. And I'll just go over those real quick. Once you follow that QR code, Corey, can you still see? You see this updated screen here?
Yeah, I
Okay,
can see it.
cool.
It's a little small, but I can see the
Okay.
yeah, there you go. Perfect.
Perfect. Right on. Thank you. So the first one is you can click on this link here and request your real estate report card. This is what Ryan was talking about earlier, where we can get professional grade analytics down to the street and the specific price of the home you're considering buying. So if you own a home now and you're thinking, should I sell it or should I keep it? You should get a real estate report card. If you're looking at a new neighborhood and price range, you should get a neighborhood report card for that area. The other thing that we had alluded to here is if you're interested in opening up access to a home equity line of credit to access capital before an opportunity presents itself, which with the trajectory of interest rates this year, I think there's going to be a lot of opportunities, but you want to get ahead of that and open up a line of credit, you could schedule a consultation with us. We'll be happy to answer questions, explain to you how the home equity lines work. And again, you can do that on a primary residence, second home, or an investment property. And then last but not least, I created a video called Inflation Destroys Debt and Makes Intelligent Investors Rich. This is by far the most important thing I've ever learned in 25 years of real estate investing. It's essentially how to use real estate as an investment to short the value of the US dollar, which by the way has lost 97% of its purchasing power since 1971. And we show you how to use inflation to your benefit in that video. So again, if you want to follow the link, happy to give you all those gifts, and we'd be happy to answer any of the questions you have. Over to you, Corey.
Love it. Hopefully there was, a lot of value. I mean, I know even every time I chat with you, Josh, I learned something new. So like, hopefully there was some value that you guys got from this. If you're in the market for looking to start your real estate portfolio, you want to buy your first or next rental property, Ryan and I have a mentorship program. We literally handhold you on the way there, from foundation and strategy, deal analysis, building your team, acquisition, everyone that's helped us in our journey, we give to the people in our community, operation systems, access to deal flow, not just the deal flow that you might find on your own, but our deal flow, and then how to scale that. So if you're interested in that, I'm going to drop our Calendly link in here, but you can follow us on Instagram too. That's probably like the best way to if you're DMing us on Instagram, if you shoot us a message, it's me responding. So at WealthJuice Official, you can see my name there. But I'll drop our Calendly link in case anybody's like super interested in having a conversation. Also, I see a number of members of our community that are actually on this call, which is pretty cool to see. So thanks for joining, guys. And yeah, I just wanted to throw that in there. But hopefully this call was really useful. I know I learned a lot. Like I said, every time I have a convo with Josh, I learned something new. So
Thanks, Corey.
there's
Appreciate it.
yeah, that's our Instagram. Let me toss our Calendly link in here too.
Great. And just as an advocate of both their YouTube channel and their Instagram channel, they're always putting out actionable things for real estate investors. So if you've contemplated real estate investing, but it seemed like a high hurdle, lots of information. Appreciate you, Trevor. Appreciate all the rest of you guests. Any closing words before we close it out, guys?
That's it.
I think
Thank you.
Appreciate everyone for joining. Thanks again.
Great evening. Thanks, everybody. Take care.